Hey everyone, let's talk about something we see every single day. Those scary headlines about the market. You know the ones. It feels like every time you go online, someone is predicting the next big crash. But have you ever stopped to think, are you paying a fear premium by listening to all that noise? Well, in this explainer, we're going to cut right through it and look at what the data is really telling us.
And it's a really important question, right? Because let's be honest, the business model for a lot of news sites runs on clicks, and nothing gets clicks quite like fear. So with this constant flood of terrifying headlines and doomsday predictions, it's so easy to get anxious and start making emotional decisions. But what if that whole story, what if that fear is actually costing you money? What if the reality on the ground is totally different?
And that's exactly where we're going to start. We're going to put that popular, fear-based narrative right up against the cold, hard data from the market. Let's peel back the curtain and see what's actually happening.
Okay, check this out. The disconnect here is just staggering. The narrative is screaming, the market is collapsing. But the reality? The S&P 500 is hovering just 1% away from its all-time high. We hear, this is the apocalypse. And at the same time, the Dow just broke through 50,000. The advanced decline line, which tells us how healthy the broad market is hitting new highs. Oh, and corporate earnings? A whopping 80% of companies are beating expectations. It just makes you wonder, right? Where is this collapse everyone's talking about?
So here's the bottom line. When you tune out the scary stories and you just look at the actual data, a completely different picture comes into focus. All the evidence is pointing to a strong, well-established uptrend. The market's foundation looks really solid, which is the complete opposite of that narrative of fear.
All right, so if listening to all that negativity is the problem, what's the solution? Well, it's actually pretty simple. You focus on what's working. Instead of reacting to fear, we can build a strategy around finding and investing in the market's true leaders. And our first winning sector in the spotlight today is one that is showing some incredible strength right now. Let's talk about energy. We're going to take a closer look at why this area is really demanding our attention.
Now, a fantastic way to keep a pulse on the entire energy sector is through an ETF. That's an exchange-traded fund. And for this one, the ticker is XLE. Think of this fund like a barometer for the health of all the big energy companies. And right now, that barometer is pointing to some very clear skies ahead.
And the signals from the chart are just screaming strength. First off, the sector is in a very clear uptrend. But, and this is the big one, it has smashed through a key long-term resistance level. You can think of that as a price ceiling it just couldn't get past for a long time. Well, it's through now, and that is a very bullish sign. We're even seeing the leaders inside the sector, like ExxonMobil, break through their own key price ceilings. This all points to some serious momentum.
Now, if we drill down a little deeper inside of energy, there's another really interesting spot: oil exploration and production. We can track that with the ETF XOP. And this little corner of the market looks like it could be setting up for a really major move. So, take a look at this setup. Since way back in 2022, this whole sector has just been moving sideways, building this massive foundation. Imagine a spring just getting coiled tighter and tighter and tighter, storing up all this potential energy. The magic number to watch is $157. If it can get a convincing move above that level, that could be what releases all that stored energy in a really powerful rally. It's a classic setup you definitely want to keep an eye on.
All right, let's switch gears. We're going to look at another part of the market that's been quietly doing really well, even though it's had its own share of negative headlines. Let's talk about banks and so-called value stocks.
I mean, remember all the scary stories about regional banks not too long ago? Yeah. If you only read the headlines, you would probably want to stay a million miles away. But what does the chart say? Let's take a peek at the regional banking ETF, ticker KBE.
And what do you know? The chart tells a completely different story. Despite all that negative chatter, the sector is in a sustained upward move. Based on the price action alone, regional banks are, right now, a winning sector. This is just a perfect example of why it pays to follow the data, not the drama.
Now, you've probably heard this term value stocks thrown around. So what does that actually mean? Well, generally, these are companies with rock-solid finances, good balance sheets. They have consistent, reliable earnings, and they're really good at generating cash. They might not be the flashiest companies out there, but they're often very sturdy. And right now, this group is actually outperforming the high-flying growth stocks.
And if you want to see this trend in action, you can look at an ETF like SPVM. It basically focuses on companies that combine that value with strong momentum. And surprise, surprise, its chart tells the exact same story as the other winners we've looked at, a powerful upward trend. So why would you focus on fear when you can focus on this kind of strength?
But of course, it's not all sunshine and roses everywhere. A huge part of a winning strategy is also knowing what to avoid. So let's turn our attention now to a sector that is facing some pretty serious headwinds.
Negative 32%. Yeah, that's a big drop. Since late October of last year, the software sector ETF, ticker IGV, has fallen by that much. So the big question is, why? What's going on here?
And what's really fascinating is that we don't have to guess. The answer is coming from inside the industry itself. Companies like Monday.com are basically saying it out loud. Artificial intelligence is fundamentally messing with their business models. So this isn't just some temporary dip, it's a major structural shift that's putting real pressure on the whole sector.
But, and this is a really important but, we can't just paint all of technology with the same brush. The weakness seems very concentrated on these specific software companies. Other areas of tech are still incredibly strong. You look at established giants like Cisco or the absolute linchpin of the chip world, Taiwan Semiconductor, they are both in powerful uptrends. It's all about being selective, not just avoiding tech altogether.
So we've looked at the data versus the narrative. We've identified some winning sectors and some losing ones. But the final piece of this puzzle, and honestly maybe the most important piece, is your own mindset. Let's bring this all home with a final lesson on the psychology of winning. You see, our natural instincts often work directly against us in the market. A winning strategy means you have to fight those instincts. Number one, you have to let your winners run. Fear makes us want to snatch a tiny profit off the table, but the really big gains come from riding those strong trends. Number two, cut your losses quickly. Hope is a terrible strategy. It makes us hold on, but you have to protect your capital. And finally, stop trying to protect against every little correction. More money has been lost trying to dodge corrections than has been lost in the corrections themselves.
So the key takeaway from all of this is actually pretty simple, but it's incredibly profound. Fear pushes us to cut our winning trades short and hold on to our losing ones forever. The real goal is to train yourself to do the exact opposite. Cut the losers, let the winners ride, and focus on the data, not all the drama. Thanks for tuning in.